So I'm here today to tell you guys why support and resistance does not work. For example, here we have a bottom, and we may see eventually that the market will come back over to this bottom, creating a double bottom or WM or whatever you want to call it. Okay, so once we see this pattern, a lot of people will start to buy. Right? But once they start buying, guess what happens? The market turns around and goes actually below this low, resulting you probably will get stopped out, especially if you have moved your stop loss to break even. So a lot of people probably bought in here with the targets, these highs, and then the market turned around. So either hit your stop loss or it came around and hit break even to only just then finally go up and clear these highs. So why does that happen? Especially if you're learning off YouTube, guys. Why do you feel like sometimes people are buying these support and resistance areas and they're making money, but you, 9 times out of 10, are getting stopped out? And those 9 times out of 10, you're like, okay, my stop loss is too tight and I move it, which also doesn't work because then you just end up losing more money. So gaps in price are where the market has gone and has moved up very quickly, and then the lack of interest has caused the market to fall. So yes, there's buyers and sellers that cause the market to go up, and there's buyers and sellers that cause the market to go down. However, sometimes there's so many buyers, and then people are closing positions thinking that the market's going to go down or reverse, but people just close positions, not necessarily even sellers. And then the market kind of starts falling, and then sellers come in the market. So the banks can push the market down in those times, or it can just start falling and then people start selling. So when that happens, there's actually a gap in price. So in this chart, guys, I'm showing you what really happens. When people are placing buy orders and sell orders, this is public knowledge shown to the bank, and it affects the market. So when the bid price is withdrawn, this lack of interest will be represented in a smaller number of contracts being placed in the ask column, and therefore the price will be able to move more easily upwards with very little buying power. This kind of shows that a lot of people think it's like tug of war, like if there's buyers or sellers there's buyers. Not necessarily, and there's different reasons why the price will move in the market. Two of these tools we can use to understand the result of this interaction between the supply and demand are price and volume. Imbalance in the market is literally where you're looking at the candlesticks. So there is a gap where this candle before, the last down candle before the up move, didn't connect with this candle for the up move. So what I mean by that is this space between this candle and this candle is called imbalance. So if you guys notice, in every single scenario, in healthy price action, let's say with this candle comes down, closes, opens, fills, close, open, fills, comes up. So when this candle comes up here, comes down, opens, this candle also comes back down to fill in this space right here. Okay, so the candles opens and closes and the wicks are supposed to fill in all spots within a healthy price action in the market, right? Because it's tug of war going up and down. So when it opens and closes, it should start and end from the previous candle. Okay, so when that doesn't happen, that means there's a gap, there's a balance. So whether the banks come in and slam the market down just to push it up and have some people hit their stop losses, or a lack of interest, okay? So all you guys really have to know from that is when there is a gap between the last down candle before the up move or the last up candle before the down move, that is imbalance, and that is what we're talking about in the market in terms of gaps. So now, what do we do with that information once we find it? Well, starting the first point, which is what I'm going to talk about today, is that gaps get filled. When these imbalances happen, the market will come back and fill these orders, the imbalance in the market. Okay, so when that happened, we did get a double bottom, and again, that's what's going to entice more people to buy, for it to only spring down, collect more stop losses, then continue going up, which is more related to Wyckoff, but that will be in another video. Let's find another gap. Okay, I can see one. And it takes a long time for your eye to be trained. I try to look at places where there's like a lot of selling or buying volume. So this big black candle right here, or red candle, technically it's a sell candle. Okay, so the gap between here and price only coming back up to here. okay, gets filled over here. So when this particular area gets filled, this is actually within a Wyckoff schematic. So in the next video, I'm going to talk more about Wyckoff and liquidity. This is just a very, very, very plain Jane way of talking about gaps in the market. So I'll find a few more examples of gaps in the market, and then within the series, I'll explain more on how to put them together. Here's a gap here. Gaps in the middle of the range get closed very easily. I always like to look for gaps at the top and the bottom because I want to obviously sell or buy the whole range to make a lot of money, right? This is called the order block. Again, strong selling movement and strong buying movement. When this happens, 50% of that candle will usually get filled. Again, kind of a separate training. But like I said, strong selling movement, strong buying movement, came back, just wicked it to fill in the price imbalance within there, kept going up. This is another imbalance right here. Came up, did a retest off the zone, but this did not get filled. Let's see if it got filled. This one did not get filled. So this is actually another point of interest. So what that means that when the market comes down to this area again, right now, oh, we just got to fill up here, right? So right now, eventually the market just goes up and down, and I don't want to use this to predict which way the market is going because it will go up and down. So it could go down all the way down here, or it could go up, obviously. These are just points of interest. So these points of interest, guys, are your support and resistance now. That's the only point I'm really trying to prove. Okay, so instead of using up here support and resistance and buying and trying to get a buy in there, you want to get it from the close, which is right here. Okay, same with here. Instead of trying to, have a sell here, or I don't even know where people put sells and buys with support and resistance. Maybe here. It actually might sell here and not fill someone's order. These are your support and resistance areas, not actually where price went. You want to look for imbalance. It will play in these areas so people create scenarios in their head that, oh, let's buy here, sell here, but then someone will get wicked out right here when it comes down. So this imbalance actually didn't get filled. Let's go back. What do we see here? Imbalance. So imbalance has to get filled all the way up to the wick. So right here. Boom. So a lot of times, sometimes you'll see price come down, retest the area that's very close, or retest the beginning again to create another double top. So there's someone in here trying to sell and then be surprised when it goes back up. Boom. Okay, so this one got filled. And it may not reject when it gets filled. As you see right here, it broke the area. It did come down. And this is more Wyckoff, which we'll talk about later in the next video again. But again, double bottoms. 1, 2, triple bottoms, whatever you want to call it. This is called a spring, when the liquidity gets captured and then goes in the direction. That is enough for today's lesson about imbalance and gaps and why support resistance doesn't work. I am going to go into more detail about liquidity, the Wyckoff schematic itself, and how everything works. So today's video was pretty much all about gaps and where they come from. There's a book called the Wyckoff methodology, and you can find it on Scribd. Scribd is like a platform like Audible, but you want to be able to see the book, right? So Audible is not really good for that. So it's called Scribd, where you can actually see everything that's going on and all the images and stuff that I put on the screen. So definitely read that book and check out more information. If you are kind of unaware on how the banks even move the market, I will link another video below. Okay, so the book to find out more information on how the banks actually move the market and how they try to manipulate the market and hit people's stop loss is the book on YouTube, which is called The Reminiscences of a Stock Operator. First chapter, which is only 25 minutes, guys, is very, very, very informative to give you guys a kind of a visual or audible version of how the banks actually move the market. That's it for today, guys. Thank you guys for watching today's video. Please please subscribe if you want to see more videos in this series on how I'm going to show you guys more about Wyckoff and liquidity in the market, which is the real way of trading and not these crazy ass patterns that don't really work. So thank you so much, and I'll see you in the next video.